how to quickly and easily learn the annual Blue Book value for your financial advisor practice. Every advisor needs to know their ongoing valuation for their firm, and this is the easiest way to get the price as often as you want it. Welcome to The Rare Advisor, where we discuss the business model supercharged by recurring and repeatable events. My name is Mike Walters. I'm the CEO here at USA Financial, and today I am joined by Brent Enders, my business partner, as well as president here at USA Financial. And we are going to be diving into the valuation of your practice, most specifically what we call the Blue Book value, and how you can easily and quickly get a Blue Book value on your practice. Brent, welcome. Thanks for helping me out here today.
Yeah, glad to be here. It's an exciting topic, Mike. Interestingly, I've had this very conversation 4 times just this week.
Perfect. And you're going to be well-versed.
Plenty of advisors want to know how this works and how they should be viewing their practice. You know, a lot of times they focus on sales and revenue, and those are the fun, easy things to keep track of. But at the end of the day, it's really about kind of the value of the equity you're building in your firm, and what is it really worth, and then what can you do with that value at some point.
Yeah. So the beauty of this is, the number one most valuable item in most financial advisors' portfolio is the ownership of their practice, the actual value of the practice. And we have these conversations so often because we help our advisors and we really dive deep in terms of transition items and acquisitions and succession planning and so on and so forth. So we've actually have developed what we call the Advisor Blue Book. It's actually a tool that we've created, and it specifically is there for an advisor to get a quick glimpse at what the overall value of their practice represents in today's current marketplace. So we track a lot of the multiples, we track a lot of the trending in the industry, we stay in touch with some of the appraisal type firms, and we tweak it on an ongoing basis to make sure that it is staying accurate. But it is really, it's like getting a Blue Book value on your car, right? You Google it up, you actually type in a bunch of information about the vehicle, the what kind of package it has, what size engine it has, does it have leather interior, so on and so forth. And then it tells you here's essentially what the value of that vehicle would be. Now we know that those change based on mileage and based on the geography and where you live and all these other little factors. So that stuff all still can happen to a certain degree. But what we find is that the Blue Book value is usually within 2 or 3% of the value that you would get if you paid for a full-blown business appraisal. So it's a great tool that really allows you to essentially get kind of almost like your own stock value to figure out what your current value is. And we recommend you visit that often, at least once a year, but more likely probably on a quarterly event would be really smart to track that.
Yeah, you're right, Mike. There's a couple of ways to consider the values and why you need to kind of track them fairly frequently. There are the market or economic conditions that can drive the value of a practice up and down. But then there's also things inside of the business that you actually have way more control over. You don't control a stock market crash. You don't control a pandemic and the impact it can have on your firm. But there are things inside your firm that you do control that can drive the values up and down. So, we look at both the economic and market factors when we're looking at our Blue Book values and trying to dial in what an advisor practice is worth. We keep an eye on that, but then we also know behind the scenes what advisors can do to drive their values up and down. And it's nice to know they at least have a lot of control over that.
Yeah. And the good news is that because of the industry that we're in, and you cannot say this about all other industries, but the financial services industry is unique in the sense that what's good for your balance sheet is almost always the same thing that is good for your P&L statement. So if you are driving up your revenues and you're doing so in a way that is in the best interest of your client in addition to the best interest of you, then that is most likely driving up the balance sheet in the right fashion as well. There's only a few times where that'll get a little bit out of sync for some people. One of them, which comes right back to your point of having things you can control that increase and decrease the values of your business. And in fact, we have a report, the Advisor Blue Book report that we have created some time ago, and we can get that to you. We keep that freshened up as well. But there is a whole selection of, what I call the up and down arrows. And we've got pages of these, which are different items that you can control inside your practice. And then we'll identify, if you're doing this, it elevates the value of your practice. If you're doing that, it devaluates your practice. And one of the big ones that people run into almost all the time is determining how do they want to handle their portfolio management. Do they want to be what's called rep as PM, rep as portfolio manager? And that would mean, if you're not familiar with that term, what that really means is that the retail rep, the financial advisor, has decided that they're going to take over all of the decision making within the portfolio. They're going to determine what the buy and sell triggers are. They're going to determine what stocks and individual ETFs and so on and so forth are being held and why. So they're designing the parameters of the model, the triggering events that would take place, what trade day looks like to make any adjustments, what would force any of these adjustments. They're essentially playing asset manager or money manager. If you are doing that, this is one of those examples where that might be okay for your P&L statement, but it is in fact hurting your balance sheet or your net worth statement. And the reason is that people want to buy your business. There is a definite market for people wanting to buy your practice, buy your business, but they do not want to buy your job.
Okay.
And if they have to try to climb inside your head and determine what you are doing to manage those investment models or those investment portfolios, then that's not very leverageable. As an outside investor, I'm not interested in buying your job and having to figure that out. Now, if I flip that coin over and you're using a TAMP program or you're using a lot of third-party asset managers, so you're designing what the overall portfolio looks like, but then you're letting specialists do their job inside of the portfolio so that they are bringing to the table the areas that they have expertise in, and you're essentially kind of managing those managers, if you will. Well, now from an outside perspective, from an investor interested in buying your practice, that has scalability. There are systems and processes in place. I can leverage that. It doesn't matter how many new clients I add. I'm not adding a lot of workload. I'm not taking on all this extra liability for making those decisions internally myself versus an outsider, and so on and so forth. So in that example, that's kind of one of those little teeter-totters. If you're considering all things equal and you start doing rep as PM, it drives it down. But if you start doing asset managers, third-party managers, TAMP programs, that will drive up the value of your practice. And that's just one example.
You're right, Mike. And then we could go on another day, and we probably will, about other decisions you have to make about rep as PM and the pros and the cons of that. But it's a great example of one lever somebody can pull that can drive the value up or down. And if you're in love with being rep as PM, well, then you have to be okay with the fact that your valuation is going to go down a little bit. I mean, these are choices you get to make, which is the beauty of being an independent advisor and owning your business, is you get to decide. But it's always nice to be aware of what lever pulls go up and what lever pulls cause firms to go down. So
in fact, another big one is there are two stats that are, at first glance, seem somewhat unrelated to business valuation, but if you stick with it, you'll realize how important they are. And I'm actually going to read this to you. These stats are from the industry. It came out of Investment News. 70% of widows fire their advisor after their spouse dies. So 70% of widows, meaning the surviving spouse, 70% of them are firing their advisor once the first spouse dies. Couple that together with 66% of children fire their parents' advisor after they receive the inheritance. 66% of the kids, once mom and dad are both gone, they get the money, they fire the advisor. So if you connect those two, and you are now the average financial advisor in the United States, and those statistics, therefore, are a direct reflection of you. When the first spouse dies, up to 70% of the surviving customers are letting you go. They're leaving your practice. Of those 30% that stay, once they pass, 66% of what remains, those because of the children, is going to walk out the door now as well. So imagine the erosion between those two stepping stones in a practice. So when an outsider comes in and they want to value your practice, they're going to ask a question like that.
Right.
We want to see what's the retention rate you have once the first spouse dies. And then we want to see what's the retention rate you have once both spouses die.
Right.
And if you are in those industry stats and you have an older client block, which most people do in this business, age 50 and above, is kind of where things start really picking up for financial advisors, that's going to drive your value down. But the flip side of it's also true. If you can prove to an outside individual that you have systems and processes in place, tools and techniques that allow you to actually keep the surviving spouse once the first passes, and then allow you to keep a large percent of the children once they both pass, now your valuation is going to go up because of that.
You're right, Mike. That's a great example of why you need to dig beyond, especially if you're a buyer. But even if you're a seller, you need to be aware of these things because, again, those are things you can pull up and down and adjust to help your value. What you just walked through is a great example of one of the less tangible factors that can drive the value of a firm up and down, the retention issue. Typically, an advisor, they know to recognize the amount of assets and what assets are generating recurring revenue and which ones are not, and how many clients are there and how many accounts are there. Those are kind of surface level, although important metrics and tangible things you need to know to determine your own value or determine value of another firm if you're a buyer. There are other things, like you just said, that are less tangible. Oftentimes people don't dig enough to find out, well, exactly what kind of assets are these things invested in, and how liquid are they, and how risky are they, and things like, client age does matter. Right. You purchase a mature book of business or you're selling one. If you're not careful, the value shouldn't be as good or won't be, because the obvious question is, well, how much longer are the assets liable to stay around?
Right.
And it gets back to what you just said, which is retention. So there's so many other factors, the less noticeable things you have to dig into to find out, what is a book, really and truly worth, as opposed to just the simple stuff like how many assets, how many clients.
Right. So again, now let's think this through. You're going to view these things very differently, whether you're the buyer or the seller. So if you're in acquisition mode and you see that this practice is suffering in this area, but you know how to fix that, well, that might be a great opportunity because you can buy it at a deflated value, but then you know how to create the lift in that acquisition. Right. Or the same thing could be true if you're looking at yourself and you're saying, okay, I want to exit this. I want to transition out of this business in the next 5-10 years, whatever the number is. And this is a soft spot for you. Well, there's things you can do to fix that. So, for example, with all the advisors affiliated with USA Financial, they already know that between Thanksgiving to New Year's is a great time to be running what we call family meetings, where you're specifically there to talk to the spouses, but more importantly, in those instances, the adult children, to make them understand that these plans were really put in place for them. Because again, think how sad it is when the first parent dies and the second parent wants to leave an advisor. Well, the reason they want to leave is because they don't feel like that plan was built for them. The reality is the plan is built for the surviving spouse. That's what the planning is all about. And so a lot of times it's just poor communication. It's not spending enough time with the non-financially oriented spouse, or in the next layer deep, not spending enough time with the adult children for them to realize that all of this was put in place for their best interest as well, so that now you can keep those retention numbers up. And now you've got, something that's going to make you stand out in a crowd rather than shrink your values.
Right. The other thing, Mike, that we will help advisors dig into too is once you do identify some of these less tangible items, you really got to dig another layer deep. So even let's take, for example, some of the asset class categories or the types of products that your book of business might have, or if you're a buyer, the firm you're looking at. If, say, something's generating recurring revenue, well, recurring revenue isn't always equal either. So depending on where that recurring revenue is coming from, if it's coming off say, annuities, that can be valued differently than if it's recurring revenue coming off of like old 12B1 type compensation, which is also dramatically different than asset management, true AUM fees. And so even recurring revenue is not all equal. You really got to figure out where is it coming from, because the industry has higher or lower values depending on, well, what is the recurring revenue? So one recurring revenue dollar here could be slightly valued different than a different one here if they're from kind of a different structure, different product line. So the things you have to know if you're going to be selling someday or trying to figure out what your value is, but also if you're looking at someone else's book of business.
Yeah, and that's a great point, but not to skip over the obvious as well, which is that there is a distinct difference between recurring revenue and how it's valued versus non-recurring revenue and how it's valued. So front-end commission type products, transactional type products, don't carry the same type of ongoing value in your practice as do recurring items, because again, people are buying cash flow. Right. You don't have to go out and resell the client over and over again to keep that asset under management revenue rolling. But you do if you're, selling fixed index annuities or other, commissionable products, even if it's, front end mutual fund type commissions or VAs or whatever, those do not value as high, because once they're paid, there's not much left or anything left there. And again, because of fiduciary rules and so on and so forth, it's not like you can say, well, yeah, but the surrender charges have dissipated and there's churning, availabilities and we can re-up that. Well, no, you can't do those things. And, haven't been able to do those things for decades now in the industry.
Yeah, a lot more complicated to handle insurance and annuity business the way it was 20 or 30 years ago. Like you said, you could look at a book and realize, hey, 50% of the assets are in annuities. And then you can dig in there and find out, well, half of them are free of surrender charge, which is great. But you can't assume that that means that half of those annuities could be flipped over or moved. Sometimes it might not even make sense to move them, depending on what they are. And the client might have certain riders or guarantees or death benefits that you just can't get right now. So you couldn't replace them or wouldn't be comfortable with that. And even if you do think it's in their best interest, and oftentimes it is, well, it's a fair amount of work to redo all that and to wrestle it through compliance and suitability, because you have to show that it's acceptable and it's a good move. So again, recurring revenue on annuity kind of is valued and looked a little differently than recurring revenue on, say, a true asset management type of a product, because those are a little more flexible, they're easier to move around, easier to massage. You don't have, surrender issues or resetting of surrender issues. So again, doesn't mean annuities are bad. Our firm works with a lot of annuities, but they're just viewed a little differently when it comes to value.
Right. So basically what happens is you've got, recurring revenue has a higher value, non-recurring revenue has a lower value, and then, your average is going to be somewhere in between. So it really just depends on how your practice is skewed and all of these components, which there's many, many more we didn't have time to get into today. But again, if this is valuable information to you, we just ask a simple favor. If you would subscribe, like, and follow, feel free to give us comments if you'd like, whether you're watching this on YouTube or you're seeing it or hearing it on a podcast. You know how it works. It's all pretty much the same. Subscribe and like, and that will keep us providing you this kind of information moving forward. So thanks so much for tuning in. We'll be back again soon with the next Rare Advisor.